Well, if you look at the CME contracts, what you'll find is in the last quarter of this year, there's like a huge spike into it. So the volatility is caused by the traders and also by the CME group. What did they do? Although this is not new for 2025, but as more and more interest in those silver contracts, we're not talking physical, talking about contracts. As those contracts as traders have been piling into the contracts, they've been raising the margin requirement, which actually just started yesterday as well. So, or on Monday is when those contracts went into effect, meaning that traders have to carry a lot more collateral on their books to execute these paper contract trades. So that, of course, there was a lot of profit taking on Monday's market because that's also when those margin calls went into effect. So, or the new margin, I should say, went into effect. So yeah, I mean, it's easy to manipulate it when it's a paper market, but the reality is we are also transitioning into the physical market, giving you good price discovery, which we're not there yet, right? But that transition started last January. So we're like almost a year old into that transition. So yeah, there's lots going on. You know, Ivan, I like you so much. But fairness is not really something that goes into these markets.
Right.
Because if the markets were fair, then you would see gold somewhere around $40,000 an ounce and silver likely around $2,000 an ounce. So this is about trading. And yes, there are no limitations to what they can do as far as if they want to boost that, well, then they can lower the margin requirements and encourage more leverage and debt. If they want to stop a price rise, they can raise the margin requirements to do so, like we've just seen. And no, there are no limitations. Just like the central banks lower interest rates to inspire more of this stuff.
Right.
And the markets go, woohoo! I mean, on Wall Street, every single stock analyst, every single one is anticipating a huge stock rally into 2026. Why? Because they expect the Fed to lower the rates and do a lot more of this.
Right.
We already just recently saw the Fed pivot, turning around to buy the debt of the government, which we may have talked about because this was anticipated. Of course they will. Right? So, but none of this is about fairness. None of this is even really about real capitalism. It's really just about a trading market, a gamble, which is typical at the end of every single currency's life cycle. Very typical. Well, I would say number one, don't worry about the contracts because they're not real. Go into the physical markets and hold it yourself.
Yeah.
That probably be the single biggest thing because the paper markets can whipsaw like that, but the physical markets don't whipsaw like that. That requires time in the physical world. So we know that if you don't hold it legally, you don't own it, and this is the time to be at absolute safety. Do I think that with the Fed pivot and more money printing, the markets will go up? Yeah, because we are in the melt up phase. But this looks an awful lot like 99 did. And keep in mind the derivative explosion that happened in 98 with long-term capital management that nobody really seems to know about because it was covered up so beautifully and quietly. But, I think we could see another derivative event in 2026 easily. And don't be fooled by the hype. You want to understand what's really happening. And that really is what they've been talking about openly for the last, 6-8 months, is the devaluation trade, which really is just lots more money printing, pulling the purchasing power value out of the currencies. That's what you need to protect yourself from. So you can only really do that in the physical markets. Well, personally, I like silver in any form. So yes, definitely coin form is a great way to do it, but you want a variety of sizes, right? So this is pre 1965 constitutional silver. It's roughly a tenth of an ounce. These are 90% silver. This is a new silver eagle, and that's 99.9% pure. And I even like it in this form,
Oh, nice.
sterling silver. So if it's marked sterling or it's marked 925, then it's 92.5% pure. So I really like it in any form. I'm not super keen on large bars because they're too hard to deal with. So my preference, if you want to do bars, that's fine, but do it in smaller, ounce or lower. Other than that, I'd say do it in coins. It's just a better way to go. I think really the open outbreak of World War III. That's my biggest concern because there are eruptions in all these different pockets in the world. And that is something that occurs and it justifies the inflation. It justifies a lot of loss of freedoms. It justifies a lot of things. And so it's really the geopolitical hotbed that we're moving into that has me the most concerned and what that will do to inflation and the bond market, which has already popped. That popped in 2022. They've just been like reinflating it by pumping more money into the system. But the biggest concern is probably geopolitics. Really, I think the biggest thing, and I don't think that most people realize it, is the breakdown that's really happening on Wall Street in terms of the contracts versus the physical markets. And I would say, especially with gold and silver, gold is the primary currency metal, silver's the secondary currency metal. Silver and copper are used quite a lot in AI and all of the build outs of all of these energy generating units for
Right.
AI.
When people ask me why the volatility in silver is suddenly off the charts, or why gold looks like it's sprinting toward an entirely new monetary regime, I always laugh a little bit inside. Because none of this, absolutely none of this, should be surprising to anyone who's been paying attention the last 20 years. When a system reaches the end of its life cycle, when the currency is breaking down, when the debt is unsustainable, when the central bank is cornered, the markets stop acting like markets and start acting like a wounded animal. It thrashes, it snaps, it does unpredictable things, and then right before it collapses, it tries to run. This is where we are now. The melt-up phase, where every distortion becomes bigger, every manipulation more extreme, and everybody on Wall Street pretends everything is just fine if the Fed just cuts rates one more time. And yes, the CME raising margin requirements is part of that thrashing. These paper markets are not designed for truth. They're designed for control. If they want to cool the market, they raise margins. If they want to juice speculation, they lower margins. You're not participating in price discovery. You're participating in a casino that rewrites its rules depending on whether the house is losing or winning. It's why you saw traders dumping positions the minute those new margin rules went live. Profit taking? Maybe. But more realistically, it was forced liquidation, because you can't carry your position when suddenly the collateral required jumps overnight. And that is precisely why the futures market is the worst place to judge the true value of silver or gold. Now compare that to the physical market. No forced liquidations, no algorithmic games, no spoofing, no margin hikes. Just, do you have it or do you not? Can you deliver or can you not? That's the whole story. And in 2024, that's exactly where the system began to crack, because physical started dictating the direction, not paper. We're almost 1 year into that transition, and if you think the volatility in the paper market is the real story, you're missing the whole movie. The real story is that physical is separating from paper in slow motion, and when it finally breaks, there will be no warning. One day the COMEX price will say $38 or $46 or $72, And the next day, every bullion dealer in the world will be sold out at any price you recognize. The paper market will still print numbers. Don't get me wrong. But nobody will care because no metal will move at those prices. That's the end game. That's the failure to deliver that kills confidence completely. People forget. Confidence is the only thing a fiat system has. It is the glue, the oxygen, the magic fairy dust holding it together. Once confidence breaks, nothing else matters. Not the dollar, not the euro, not the yen, not the British pound. They're all just government promises, backed by nothing but the hope that the next person will accept them tomorrow. But what happens if they don't? The answer is simple. You get a currency regime change. And that is exactly what gold is signaling right now. Take a look at gold priced against M2 money supply, the chart nobody wants to talk about on CNBC. Gold has barely begun its revaluation process. The breakout that is forming right now is one of the clearest I've seen in my entire career. In fact, if you didn't know what you were looking at, and I just handed you the chart, you'd say, "Oh, Lynette, that thing is about to double." And you'd be right. Gold is not rising because it suddenly became more beautiful. It's rising because the dollar, the euro, the yen, they're all losing purchasing power at an accelerating rate. It's not gold going up, it's the currencies going down. Silver is the same story, but with leverage. If gold is the primary currency metal, silver is the secondary one, the monetary metal that gets treated like some industrial commodity by Wall Street until the end of each cycle, when suddenly everyone remembers its monetary role. It's the same pattern every time. When people finally panic, they don't just want gold, they want anything that can move fast. Silver is the leverage play on the collapse of trust. If gold doubles, silver tends to triple or quadruple. And if gold rewrites its entire valuation, well, silver becomes the slingshot. Look at silver's chart against M2, the way we were just discussing with Michael Oliver. Just reaching the 2011 high would be a double from here. That's the conservative move. But when you overlay the monetary cycle and the physical shortages, it stops being conservative and becomes inevitable. Silver is behaving like it did before the explosive phases of 1979 and 2011. It pauses, it coils, it forms tight bull flags, and then it erupts. And I don't mean increments, I mean limit up, melt up, no offer type of moves. The CME knows this, which is why margin hikes show up every time silver gets wind of itself. But margin hikes don't change the underlying shortage. They don't create new mine supply. They don't replace the silver that's been gobbled up by India, China, tech companies, and solar manufacturers. They just delay the inevitable. I said this before, and I'll say it again. If markets were actually fair, gold would be $40,000 an ounce, and silver would be somewhere around $2,000. And you know what? I'm not even sure those numbers are high enough if we measured against true monetary destruction. The only reason gold and silver trade lower than that is because of the derivative market. And the only reason the derivative market still works is because most people never stand for delivery. But that's changing. Every month, a little more metal is taken off the exchanges. Every month, the inventories thin out just a little more. At some point, some trader, maybe by accident, maybe by design, will demand physical delivery the system can't provide. That moment is the spark. That's the end. That's your Lehman moment for the monetary system. Now let's talk about rate cuts. Everybody on Wall Street right now is celebrating the coming rate cuts like it's Santa Claus showing up early. Everyone expects a huge melt-up in equities into 2026. And in a sense, they're right, for all the wrong reasons. Rate cuts don't save markets at the end of a cycle. They expose the problem. They signal that the Fed is panicking. Every major crash in modern financial history happened after rate cuts, not before. The bulls don't want to hear that. They want to believe liquidity will save everything. But when the liquidity is needed to prevent the treasury market from breaking, you're not in a bullish environment. You're in triage. And the derivatives market, well, that's the real bomb. People forget LTCM in 1998 because it was covered up beautifully. But that event nearly took down the global financial system, and the derivative market was tiny compared to today. Now, derivatives are not $1 trillion, not $10 trillion, try 700 plus trillion notionally, depending on how you count. And most of that sits atop interest rates, currencies, and sovereign debt. If you think a shock in 2026 is impossible, you're not looking at the actual architecture of the global financial system.